Hello everyone, and welcome to today's Q and AMP webinar, where we will discuss investment markets and economic recovery from COVID-19. My name is Antti Rowe, and I am AMP's Chief Client Officer. While I was hoping to do this with you all in person, I'm actually really excited by the fact that we can deliver this information to you in your homes, and that this will open up the possibility for us to make this a more regular event in the future. I've never seen anything like COVID-19. It has impacted our health, our financial systems, and our social lives. Now more than ever, we need to look to the experts to help guide us through uncertainty. Presenting today will be Dr. Shane Oliver, who is AMP Capital's Chief Economist and Head of Investment Strategy. He comes from a great position of authority as he has over 36 years of experience tracking and monitoring the markets at AMP Capital. But one of the things I love about talking with Shane is that he has the amazing ability to make the complex simple. For those of you that are new to a webinar, let me explain the format. Next, I will hand over to Shane, who will run through an online presentation which will take about 40 or 45 minutes. A recording of the webinar and the presentation will be available on our website in the next couple of days, so don't worry if things move too quickly or you feel like you've missed something. If you have a question, please click on the chat and type in your question. Throughout the presentation, I'll collate the questions and come back and ask Shane at the end. We will mute you from our end, so don't worry about noise that's happening in your background. So for now, just sit back, relax, and enjoy the presentation. So that's it for the intro. I'd now like to hand over to Shane, and I'll see you again for questions.
The last few months, I must admit, have been very trying. I think we've gone through a period where we were in some fear that we might catch the virus ourselves, but particularly in my case, my mother is 87 years old. Just turned 87 a week ago, and of course we do worry about our older relatives and our loved ones. So fortunately, I think Australia has managed the crisis pretty well, both in terms of the virus and, as I will explain, I think also in terms of the underlying economic impact. It's not to say it's been easy, it certainly hasn't, but I think if we look at a lot of other countries around the world, it looks a lot worse than the situation has been in Australia. So if we just move on to the first slide, I think one of the things worth mentioning here is what it might mean for one's retirement. I'm getting on a bit. As you just heard from Matt there, I've been at AMP for 36 years now. So naturally, I'm looking at what it means for my superannuation. Share markets had a big fall. So what I've shown there on the left-hand side there is the value of the Australian share market and the US share market indexed to a level of 100 back in the year 2000, January 2000. You can see the big run up into the tech boom, then the hit from the tech boom, then the run up post the GFC, and then of course we've seen the fallback recently. Now, to put that in context, the GFC falls that we saw around 2008 were around 55%. The recent falls we saw in markets going from February into March were around about 35%. A little bit more in Australia, a little bit less in the US, a little bit more in Europe and so on, but around 35%. Now, since then, just looking at our market today, it's up almost 2% or so, similar rally yesterday. So far, we've recovered almost 25% of the decline, and the US share market has recovered over 30% of the decline. So a lot of that big fall we saw has been partly recovered. When I look at my own superannuation, which is invested in a well-diversified, growth-oriented fund, I noticed that when I looked at it a few weeks ago, it was down about 2% on where it was a year ago. So yes, it's down from the highs we saw earlier this year, but it hasn't been anywhere near as bad as the fall in share markets would suggest because of the diversified nature of that superannuation fund. And of course, measured against a year ago, it's not been a disaster, particularly given that super funds have had pretty good returns over the last 5 and 10 years. So that's what I've shown here on the right-hand side chart. The average return from a balanced growth superannuation fund. We had some pretty good years in there, particularly last calendar year. We've given some back, but I don't think the falls that we've seen should have a major impact on one's retirement, unless, of course, you're invested in very risky investments coming into this coronavirus shock. So if we move on to the next slide, big question, what might recovery look? If this was 2 months ago, we'd be debating whether there will be a recovery at all. We didn't even know whether the shutdown would work. The good news is that it does seem to have worked, and I've got some charts on that. So if we move on to the next one, this just summarises our view we do expect to see a big hit to economic activity through the current quarter. Now, most of that has already been seen. That's when you and I and lots of other people were told to stay at home, don't go to work, or if you do go to work, you can't go out on the weekends, all that sort of stuff. And that meant we couldn't spend. We couldn't do the normal things that happen. And so consequently, that's going to detract a lot from Australian economic activity. Pretty much the same story right around the world, as people can't spend because they're stuck at home and economic activity couldn't occur. Through the second half of the year, I think there will be some sort of recovery. I think the low point, I'll talk about this in a moment, was probably around April. We've started to pick up again recently. I was out the last couple of Saturday mornings, looking for a car park in my local suburb, and I couldn't find one. I ended up a long way away again, like the old days. A month or so ago, that certainly wasn't the case. So it does seem people are out again. People are starting to spend again. So we're starting to see some sort of recovery, but that will mainly impact and show up in what we call GDP numbers for the September quarter and the December quarter. So point is, I think we're going to see a bit of a recovery from here. It's going to be gradual. It's going to take a while to get back to normal, but we're starting to see that recovery now. Another key point, inflation is very low. So that means that it's very easy for central banks to keep interest rates at very low levels. Not so good for retirees. My mother regularly complains about this, but by the same token, those very low interest rates are good news for people with mortgages and helps their spending. And we've also seen a lot of fiscal stimulus. So all of those things combined, I think, will help ameliorate the hit to economic activity. If we didn't have those sorts of stimulus measures, funding going to the banks to make sure they can keep lending, to keep credit flowing through the economy, if we didn't have the JobKeeper scheme or the Jobseeker scheme or the bank payment holiday, all of those things, I think if we didn't have those things, we would have seen a much bigger hit to economic activity. So basically, those initiatives have helped protect us through this period, such that when things do start to return to normal, as they're gradually starting to do, economic activity can return. If we didn't have that, we would have seen lots of businesses gone bust and those jobs simply wouldn't have been there. So I think that's very important. And when you think about, a lot of people do comparisons to the 1930s, this is worse than the Great Depression, all that sort of stuff. Well, in terms of measured economic activity, it may feel worse than the Great Depression. Now, for example, last week we were told in Australia that retail sales fell 17.9% in the month of April. You won't see anything like that in the whole of the post-war period. You've really got to go back to the 1930s to see that sort of contraction. But by the same token, it is a very different environment. The run-up to this downturn is different to the 1920s. The 1920s, we had the roaring 20s. We had a massive boom. Often when you have a massive boom, you have a massive bust. We certainly didn't have a boom, so there's no logic as to why we should have a massive bust. Secondly, we've seen a lot of fiscal stimulus, easy monetary policy, whereas in the 1930s, they thought the trick back then was to balance budgets. So when tax revenue stopped coming in, they raised taxes. A lot of banks went bust in the 1930s. This time around, they've done whatever they can to stop banks going bust. So those things are very different to the 1930s. Yes, on some measures, it may look a bit like that, but on most, it doesn't look like that at all. So in share markets, what should you do with your investments? I reckon in the short term, it's very hard to say what will happen here. We've had a big run up. It could have got ahead of itself. It could have a pullback. But trying to time that, I think, is going to be very difficult. I think there was a lot of people thinking on the 23rd of March, when the Aussie share market was down nearly 37%, thinking this is terrible, it's going to fall another 20, 30%, only to then find the market rallied to now about 25%. So it's very hard to time the markets in the short term. What I do think, though, is that as this recovery unfolds, share markets will rise on a 12-month, on a 24-month horizon. What are the key things to watch here? Obviously, keep an eye out whether we're going to have a second wave or not. That would be a major problem. I'll talk about that a little bit later. Timely economic indicators, obviously worth keeping an eye on. Unemployment, policy stimulus, we've seen a lot of that, and an emerging issue is tensions between US and China. So that's a sort of a summary of the backdrop here, but our base case is that we've probably seen the worst, and on a 12 to 24 month horizon, share markets and other related investments will be up in value. So if we just move on to the next slide, which shows a gauge as to how we were prepared for a pandemic. And the good news was, when I looked at that chart, I saw this earlier this year, around about February, it looked like Australia had no problem. We were deep yellow there. We were well prepared for a pandemic. And then I looked at America, they are as well. Then I think that all fell apart when I saw the next chart, which saw this guy holding the same chart up. He didn't get it from me. I don't know where he got it from, but holding the same chart up. And then I thought, oh, geez, I don't know about America. And of course, America hasn't been that well prepared. Its response was actually quite poor, I think, to this crisis, which shows up in much higher death rate, for example, in the US than we've seen in Australia. But if we move on to the next slide, what it shows is coronavirus cases around the world. You need to look at some numbers here. These numbers were from a couple of days ago when we put these charts together. The daily flow of new cases has actually fell a bit again in the last few days, but it doesn't change the picture. What you've seen on the top left chart there is the total number of cases of coronavirus. That's the blue bars. We're now over 5.5 million, in fact, up to today. The red line is the number of new cases on a daily basis. It peaked, or it sort of got to the top of the range, big acceleration into the end of March. Since then, it's really tracked sideways. Bit of a rising trend recently, but the broad picture is a lot of ranging sideways, up and down, but a broad sideways trend. What's driving that? China. That's where the issue came to the fore earlier this year, got its cases under control. A lot of debate about the reliability of data put out by anybody, but I think it's roughly right. Otherwise, they wouldn't have been able to reopen their economy again. Then Europe started to become a big problem, particularly Italy at the end of February going into March. And then, of course, what we've seen in Europe is a downtrend. We're starting to see a downtrend in the US. Just run through some other countries. We're seeing, this is the top right chart there, a downtrend in Japan and Australia. So big chunks of the world, the developed world, are seeing a downtrend in the number of new cases. Where the problem is biggest at the moment is in the emerging world. That's the rest of the world, the ROW line, the green line there, and it's still trending up. Big problems in Brazil, Mexico, Iran. If you want to see a country with a second wave, Iran is an example of that. India. So it's sort of morphed into a problem more in the emerging world. The other thing you can note there is that deaths per capita, or deaths per million people, that's the bottom chart there. Australia, thankfully, is at the very low part of that chart. We've so far seen something like 102 deaths or thereabouts, but that's about 4 deaths per million people. If we were seeing a rate of deaths like they were seeing, say, in the UK or Italy, over 500 per capita, per million people rather, that would mean another 12,500 deaths in Australia, which I don't think would have been a good outcome. And I have to say, I would rather put people's lives over the economy any day. There is some balancing always there, but I think at the end of the day, I'd rather have my mother with me rather than take those risks as many other countries have, including Sweden. Sweden went down the herd immunity path, but you look at the death rate there, it's actually quite high. So if we move on to the next slide, which shows number of cases on a daily basis. So I'm looking at the flow of new cases here. You can see China became a problem earlier this year. Then they had a lockdown 2 or 3 weeks later. The number of new cases peaked. And then come the end of February, going into March, they were able to start reopening their economy. And that's evident in economic data coming out of China, which has started to pick up again after a huge hit in the first quarter of this year, particularly centred on February. Lo and behold, Italy has followed a similar pattern. No, we don't have a problem. Then a little while later, yes, we have a big problem. Lockdown announced. A little while after that, number of new cases starts to slow, and then they can announce measures to start opening up their economy. That's a similar story across Europe. Australia, similar story again, following that same pattern in China. And finally, the US, although in the US, the downtrend is not as strong as it has been in Europe and Australia. So I think there's some positives there in the sense that if we can keep the number of cases low, as we have been lately in Australia, and if we do have breakouts, make sure we do a much better job of tracking people, quarantining them, not letting people in off the Ruby Princess, doing all those sort of silly mistakes, then I think we can put this problem behind us gradually. Doesn't mean we're going to go straight back to normal. It's going to take a while before foreigners will be allowed back in as travellers, as tourists, but I think we can be on the path to recovery. Now, just on that front, the next chart is a very complicated table, which I won't go through in full detail. You can look at it in your own time. What it shows is a comparison of rich countries, or OECD countries. So we've got 37 countries in the OECD, and I've shown how they rank in terms of their performance in controlling coronavirus. So I'm not looking at deaths per capita here. I'm focusing on recovery rates. I'm looking at active cases relative to the size of the population. I'm looking at total cases relative to the size of the population. And I'm also looking at the testing rate. Donald Trump keeps telling me he's got a great testing rate, but his testing rate is still below that in Australia. And you can see there on that chart that Australia ranks number 2, trailing New Zealand. They picked us just a few days ago, or a week or so ago, in terms of this comparison. The worst ranked countries are the US, Sweden, Chile, France, Netherlands, and so on. So we have done a pretty good job. And I think that does give us a bit of confidence that the management of this whole issue in Australia has been undertaken in a fairly sensible way. We haven't gone over the top in terms of the economic restrictions. The shutdown wasn't as severe as it was in New Zealand, so they're going to take a bigger hit to their economy, but it did achieve a similar outcome to what we saw in New Zealand. So I think that's something we as Australians should be proud of. If I move on to the next slide, and I think that will have implications for our economy. Now, we know the global economy has been hard hit. The chart there shows GDP growth in red. You can see the GFC there back in 2008, bit of a hit to growth, but it got as low as about 0. This time around, we're probably going to see an outright contraction in the global economy this year, and quite a severe one. The blue line is a measure of business confidence, what we call PMIs. You might sometimes hear this if you focus on investments a lot. And you can see a big slump. That was into April. The May data is shown there with that dashed line and the asterisk or the star. So there's been a bit of a bounce back. Looks to me like economic activity globally, particularly in the US, Europe and so on, was probably at the worst in April. And we might be bouncing along the bottom here. And I think it's a similar story in Australia. If we move on to the next slide again, what it shows is what I think is very important. Now, economic data normally comes out with a bit of a lag. You know, you find out what happened to GDP growth. We haven't even got the data for the March quarter yet. It will come out next week. So a 2-month lag there. So oftentimes you've got to find other things to look at to give you a better handle as to what's going on. So what we've done here, this great guy on my team did this, he put together a whole bunch of economic indicators that come out on a weekly basis. Like there's consumer confidence measures, there's restaurant bookings, there's airline travel. Both those two don't look too good at the moment, but they look to be bottoming out. There's searches. You know, whenever you go on your phone and ask Google or Apple Maps for direction, it gets registered, and they have an index of that. It's called a mobility index. And the thing is, it's starting to tick up again. In fact, it's ticked up quite a lot, both in the US and Australia. So we also look at things like foot traffic through shopping centres, through cities. So you can track all this stuff, and it tells us that the US economy fell off a cliff at the end of March. It's been bouncing along the bottom ever since. Some of the components are starting to edge up. So I think that's a fairly positive sign in relation to the US. So if you think about why is the US share market picking up, despite all these worries, despite this wall of worry, 2 good reasons. One is number of new cases is starting to come down. We're seeing reopenings, and that's starting to show up in somewhat better economic activity, or at least economic activity looks to have bottomed. And you've got very low interest rates. So all of those things explain, I think, why the US share market's gone up, and also our market. If we move on to the next slide, this is a bit technical. I won't go into it in detail. Most of the charts there relate to the rate of economic growth. And you could argue, well, it's going to look like a deep V. You're going to have this horrible June quarter in the case of the US and a horrible March quarter in the case of China, and then growth picks up thereafter. So it looks like a V, a deep V sort of pattern. But if you look at it in terms of the level of economic activity, it's probably going to be a lot slower. The recovery will be a lot slower. So if you're asking what's the recovery going to look like, I'd say it's going to be somewhat constrained. A lot of things will come back quickly. People wanting to go down and sit in a cafe and eat coffee, that seems to have come back fairly quickly, at least where I live anyway. But other things will come back more slowly, like travel, like students coming to our universities, like migrants, that will come back more slowly. And some industries, some businesses will suffer here. They may not come back. So it's going to take a while. So if I look at the world economy there, the top left chart shows the rate of growth, looks like a deep V. If I focus on the level of economic activity, which is real GDP, basically, it's the bottom left chart. And we probably won't get back to pre-coronavirus levels of global economic activity till the end of next year or the start of 2022. It's going to take a little while to get there. But I think the key for share markets, the key for investors, is that we're starting to head in the right direction. So if we move on to the next slide, which shows our signposts. Sorry if my eyes jump around sometimes. Sometimes I'm looking at the slides, which I can see in front of me, and other times I'll look back at the camera. But it's obviously I've got to look at the slides sometimes to see where we're going here. Just in signposts, back in March, we realised this is going to be a fairly complicated thing. It's not your normal economic downturn. We have to look at some different economic indicators. And so we put some signposts together. Many of those relate to status or how well we're controlling the virus. We also looked at government stimulus measures because we thought that would be very important. If we're going to take a 6% hit to world economic growth this year, then you probably need something like a 5 or 6% stimulus to try and offset that. We also looked at actual economic indicators and we looked at share markets. I have to say, compared to 2 months ago, a lot of these things tick off positively. We have seen the number of new cases come down. We're seeing evidence of curve flattening, not so much in the emerging world, but in advanced countries. We've seen massive fiscal stimulus. Jobkeeper in Australia is an example of that, or the payroll protection program in the US, which is a sort of a US equivalent. We've seen subsidies paid to businesses, all designed to keep them going so that when the shutdown ends, they can still be there. They can open their doors again. We've also seen a lot of monetary stimulus, which initially took the form of rate cuts in Australia and more recently has taken the form of what you call quantitative easing. So pumping money into the economy, partly designed to keep long-term borrowing costs down. And if you think, well, that's not working, well, I've got a mortgage. I can phone up my bank now, as I do, we all do, hopefully we all do, and say, well, I want a better deal. You can get much better deals at present. And if you want to lock in for 3 years at I saw the rates the other day, 2.3%, 2.4%, 2.2%. Nothing's been seen like that historically, those low mortgage rates. You can do that. So that will benefit a lot of households, even though my mother's not too happy getting those low rates of return on her bank deposits. But it's that demographic, that young family with a mortgage, they're the ones that change their spending the most. It's just the way the economy operates. And if they're getting lower rates, it takes pressure off them. And so you've seen a lot of stimulus. We've also seen, as I mentioned earlier, some signs that economic indicators might be getting close to bottoming, which I think is a positive sign. And finally, in relation to share markets, we saw a lot of panic back there in March, which is often a sign of a market bottom. Not necessarily, you can get more panic, but I think overall that may be a sign that we might have seen the low point in share markets. Often when you see blood on the streets, a lot of investors feeling pretty bad, and everybody's talking about it as they were in late March, then that's often a sign we may have come to the bottom. So if we move on to the next slide, which shows Australia. Now, we're a funny mob in Australia. Some of us ran off to the supermarket to buy toilet paper and toilet tissue, and that's going to provide a bit of a boost to March quarter GDP. Be kind of odd if we don't go negative in the March quarter, we then have a negative in the June quarter and then rebound in the September quarter. We'll only have one negative quarter. And some people will say that wasn't even a recession. I wouldn't get too carried away on that front. But it's interesting when you look at this slide here, the guy coming up behind has got a different priority. He's loading up with Corona. I don't want to get mixed up on names there, but Corona, he obviously got a different priority to the guy in front. Anyway, if we move on to the Aussie economy, I'm not going to go through all these slides again. If you look at the rate of economic growth, it's going to look like a deep V, but it's probably going to take to the end of next year before we get back to our pre-coronavirus levels of economic activity in Australia. So the recovery will be constrained. What I do want to focus on is that top left chart there, which shows, again, a whole bunch of economic indicators that we've combined, such as foot traffic through shopping centres, mobility indexes, how many people are asking their phone for direction, all that sort of stuff. And you can see there that it looks to have bottomed. Another indicator we include is credit card data. Commonwealth Bank, ANZ track all this stuff. We get access to that. It's been starting to pick up. People are back out there spending again. So that's giving me a bit of confidence that in the Aussie economy, the low point was probably April, and we've started to recover. Now, I've got some forecasts there for things, including the unemployment rate. I reckon if we didn't have Jobseeker and JobSeeker, the unemployment rate today would probably be kind of like it is in America, probably 15%. But we do have those things. The reality is that they are getting paid out. They are helping companies that can't pay normal salaries. You know, you go to a hairdressing salon, they're only allowed half the number of people there. So a big chunk of their hairdressers had to go on part-time or casual employment, which meant a big chunk of their salary was gone. And then you go and ask them, if you've suffered a loss in salary, well, no, I haven't. JobKeeper has topped it up, so I'm getting paid my old salary, which I think is a pretty good thing, because there will come a time when that hairdresser can open up again and have the same number of people in there, and therefore the same number of hairdressers. And then the owner of the salon will say, well, I don't need JobKeeper anymore. I'm getting enough revenue in from the customers. But in the meantime, a whole bunch of things have happened. The salon has remained in business. The hairdressers have been getting their old salary, so they haven't had a hit. And the relationship between the owner of the salon and the hairdressers has remained intact rather than being severed. I think that's all pretty positive stuff. That's why I like JobKeeper. I know they made a mistake in, people did anyway, in filling out the forms. You could probably blame Treasury for that. Maybe the form was too complicated, but it doesn't detract from the fact that it's helping 3.5 million old Australians and keeping them in jobs and keeping their companies going. So I think that was a relatively good thing. But it may have the impact of stopping the unemployment rate even getting to 9%. We're thinking it may not even get to 8%. The number that came out the other day was 6%. So providing the economy recovers enough, we may not get to those higher levels. Now, there will be a bit of a risk later this year when JobKeeper comes to an end after September, but it may only get us up to 8% or at worst 9%. So nowhere near as bad as perhaps we were fearing a few months ago. So the point about all that is, I think the Aussie economy probably bottomed in April, could be May. I don't know, I've got a lowercase there on the M for May, but probably April, and we should start to see growth through the second half of the year. If we move on to the next slide, which shows a couple of things here. A lot of people say, well, what about tourists? They can't come to Australia. Well, Australia actually loses more from international tourism than it gains. And when we go overseas, we spend up big. When the foreigners come here, they don't spend up as much. So we actually have a trade deficit in tourism. So if we're all confined to travelling in Australia and spending our money here, net, that might actually help the economy, believe it or not. Where we do have a problem is education. And I reckon some smart thinking there could bring that one back. If we say to foreign students, okay, from some date, September, August, whatever it is, you can come back to Australia. All you've got to do is have 2 negative coronavirus tests before you get on the plane. We'll test you when you get off the plane. You might have to spend a few days in quarantine, but I reckon with that testing regime in place, you could probably allow foreign students to come back to Australia. And you could also market Australia pretty well. It's one of the safest countries in terms of coronavirus to come to. So I reckon if we're smart about it, we could get foreign students coming back to help our education system. But anyway, if I think about the Aussie economy, yes, there are some dampeners there. Yes, immigration is going to be lower than it's been used to. So that's a bit of a dampener for the housing market, for housing construction, not good for home builders. Although I reckon even with immigrants, you could let them back in if you put them through a testing regime. So I think some smart thinking could solve some of these problems. But beyond that issue, and beyond the fact that Australians, like they have for a long time now, have a lot more household debt than other countries do, putting those things aside, I think the fact that we've controlled the virus better than many other countries, that we've had a better stimulus program, more focused on actual money for businesses, money for employees, as opposed to loans, and also our exposure to China should help our economy. Now, you're probably thinking, well, we've got this exposure to China, but we've got these tensions going with barley and beef and so on. Yes, that is a risk. That is certainly a risk. But I would also want to point out there that in the great scheme of things, providing it is confined to those areas, which are bad, I'm not trying to diminish the pain for barley farmers and so on, that is a big problem. But it is just worth pointing out that barley exports to China are worth about 5 days worth of iron ore. So providing we stop these tensions from getting out of hand, we should still benefit from the fact the Chinese economy is recovering faster than other economies, or recovering earlier. So I'm reasonably upbeat on Australian assets, the Australian share market and the Australian dollar from here. If we move on to the next slide. What about the budget deficit? Yeah, that's a bit of a problem. Maybe not as bad as we thought it was up until Friday, given the issue with JobKeeper. But just bear in mind that chart on the bottom right there shows the level of public debt in Australia, net public debt, as a share of our economy. And you can see there that it's quite small compared to the US, compared to Europe, compared to Japan. So our public debt problems aren't anywhere near as big as those other countries. And I think the other thing to note is that the federal government is actually borrowing money from many Australians who are stuck at home and can't spend. So the banks are currently flush with money because people get paid their salary, they can't go out and spend. So the federal government's borrowed that money to give it to those who really need it. So I think at the end of the day, they had to do what they've done. It is affordable ultimately. It's not optimal. I'd rather not have this whole event. But by the same token, I think if they were to have not done these things, we'd end up with a far worse economy, and ultimately that would have led to a far worse budgetary situation in Australia. So if we move on to the next slide, it shows the industries most affected. I'm not going to dwell on that one because we all know it's accommodation and food services, arts and recreation services. You may be aware that New South Wales will allow restaurants, cafes and pubs to return with up to 50 people in them. Come June, so that will ease a lot of the pain there, and a lot of jobs will start to come back, albeit gradually. Just moving on from that to the next chart, what might happen when things return to normal? The new normal will be a little bit different. We are seeing a phased reopening. I think we're all now familiar with that, and I like the logic of it. That you do a little bit, you see what the impact is in terms of the number of new cases of coronavirus and how our hospital system is managing. And if it all looks okay, you then move on to the next phase with the theory that being come July, most of the economy will be reopened again. I think that makes sense, and I think they're doing the right thing on that front. I won't go through all the other points on that chart in the interest of time and leaving room for questions at the end. So if we move on to the next slide, which shows Americans going shopping. There's some funny people over there in America, and obviously that's what they're wearing in Walmart. Obviously they couldn't afford masks, so they're putting plastic bags on and paper bags. But if we move on to the next slide, there will be some lasting impacts from this. I had never used Microsoft Teams before being stuck at home. I think I might have occasionally, but not much, even though we do have it at work. Now I'm quite familiar with it. Not quite as familiar as I should be. We did have some technical problems there, but that has radically changed things. You know, if you're a business, you might think, well, maybe we don't need to fly around as much as we used to conduct business. We can do things online like we're doing today. A lot of people would have discovered online shopping. 10% of retail sales in Australia is now online. It used to be about 5%. So a whole bunch of people have suddenly become open to online shopping. I still think we want to get out there again, but a lot of people are going to say, well, I didn't mind working 5 days a week at home. Maybe that was too much. Maybe I'll work 2 or 3 days a week. So all of these things are going to have a lasting impact in terms of the way we do retailing, on retailers, on office space demand. There's also issues there, lower for longer interest rates. I think that one's very important. My mother is not happy about that. But by the same token, as investors, we also have to allow for that. If you've got very low interest rates, it means servicing your mortgage is going to be kind of cheap. It also means that you have to continue to look around for investments to provide you decent income flow, while at the same time managing the risks associated with that. The other thing I think we do have to allow for is that there will be some further bringing your production back onshore, particularly in medical areas, and the tension between the US and China, and therefore Australia might get dragged into that, has probably increased as a result of all of this. And you can see there that was from a graffiti in Berlin somewhere recently. Now, hopefully, if Australia manages this okay, we can remain sort of neutral. But obviously, that tension will probably increase as we go up to the US election later this year, because history tells us US presidents don't get re-elected when unemployment goes up and there's a recession just prior to the election. So Donald Trump knows he is now at risk. One way to offset that is create a bit of distraction, wag the dog. You can go and check that film if you want to, wag the dog, rally Americans around the flag, focus on China, try and shift blame a little bit, putting aside the issue of the origin of the coronavirus, which will be interesting to see what that study finally shows. But I think at the end of the day, this could cause a bit of volatility in markets, but it's probably not going to be enough to detract from an ultimate recovery. We've heard a lot about this in the last few days, last few weeks, and yet share markets have gone up. And that's because the bigger story is the hit to economic activity when people were stuck at home, not so much the noise between Donald Trump and China. So if I move on to the next slide, opportunities for investors. These things do throw up opportunities. So we'll move on to the next one. An obvious one is in relation to share markets. Historically, we've seen a lot of bear markets. I've been around for most of those. In fact, since 1960, there's been, I won't add them up, there's been quite a lot anyway. You can see there the average decline from the high point has been 32%. The recent decline in Australian shares was 36.5%. You then typically see a quite decent rebound. Once the recovery comes, the average rebound within the first 12 months is 29%. And those rebounds can occur quite quickly. So I think the trick when you go through a bear market is to look for opportunities, because you often don't spend a lot of time down around the bottom to look for opportunities, still look for market sectors which have been oversold relative to the broader market. So I might just move on to the next slide. We do a whole bunch of valuation indicators and they're still telling us the share market is cheap. Why is that? Earnings have taken a hit, dividends will take a bit of a hit, but we also know that interest rates have fallen, and therefore in a relative sense, shares are still quite attractive, particularly in Australian shares, US shares, surprisingly, less so in Europe and Japan. And this question about the US often comes up. Why is the US share market doing so well, people say? Well, just think about it like this. The US share market doesn't have a lot of financial stocks relative to other markets around the world. Our market does. It doesn't have a lot of cyclical stocks. It's got a lower exposure to cyclical stocks, but it's got a high exposure to tech stocks. Guess who's benefiting from everyone stuck at home? And health stocks, which will benefit from the rush to get a solution to coronavirus. And when you think about their retail sector in the US, 55% of the market cap of the US retail sector is Amazon.com. The next biggest one is Home Depot. What have people been doing on their weekends in Australia? Out at Bunnings or Flower Power buying up stuff for home projects. So that's what I tend to see. And the third biggest retailer is McDonald's. And they benefit from takeaway demand. So that sort of explains why the US share market's done so well on the way up. But this chart there would suggest the US share market's still relatively cheap compared to Europe and Japan. If I move on to the next slide, which shows, I think, a quite interesting comparison. And this tells me that the dividend yield on Australian shares, even though it's been cut, is still quite attractive. Now, obviously, recent cuts to dividends haven't fully flown through to this chart yet. But once you allow for the current dividend yield, which I saw recently is around 4.5%, add in the franking credits, you still get a reasonably attractive yield or income flow out of the share market. I think what the recent experience tells us is you have to have a well-diversified portfolio. You can't just have all your money in banks hoping to get always stable dividends from them. They could cut those dividends, as we've seen recently. You might want to have some resources shares in there, which also pay good dividends. But the point is that the gap between the one-year bank deposit rate and the dividend yield is actually quite wide, and that ultimately will see money flow into the share market. If we move on to the next slide, which looks at other asset classes. Now, commercial property is going to take a little bit of a hit in the very short term because rents have come down, particularly in retail, although industrial is doing pretty well. But ultimately, that asset class, and also to some degree residential, will benefit from continuing low interest rates. So that's an ongoing source of support for those asset classes, even though there is a short-term hit going through at present. If we move on to the next slide, which shows the Australian dollar, I reckon we've probably seen the low point for the Aussie, which was around 55 cents back in, was about mid-late March. That was probably the low point, and I reckon over time we'll probably grind higher as our economy recovers faster than the US economy does, for example. If If we move on to the next slide, what about housing? I think housing has been protected recently because we've had this shutdown, people stuck at home, ban on traditional auctions. So consequently, sellers have withdrawn from the market and the number of transactions have collapsed, but we haven't seen much of a fall in prices. Now, I reckon as we go forward, we will see some pain. Unemployment could still go up a little bit from here, particularly once JobKeeper and Jobseeker comes to an end. You might see some more defaults. So we do expect that prices will come off a little bit, particularly in cities like Sydney and Melbourne, where there is more of a supply issue, and those two cities are more exposed to the reduction in immigration occurring. So prices could, for example, fall back to where they were at the middle of last year. In other words, a 10% top to bottom fall. I don't see a massive fall though. I think there's been talk recently of 30% declines. You know, some areas might get that. I've said up to 20%, but I think it's more likely around 10% on average. And one thing that will help the market is very low interest rates. So if we move on to the next slide, major asset classes, just a quick run through there. Cash, pretty low returns, around 0.25%, similar for bank deposits. Government bonds, again, low returns reflecting low yields. Share markets, vulnerable to a short-term bit of volatility. I don't know whether we'll quite see a retest of the lows. I think that's probably unlikely, but should have a solid 12 to 24 months. Bit of an issue for unlisted commercial property infrastructure in the very short term, but probably okay on a 12-month or a 24-month horizon. And on the Aussie dollar, probably close to at the bottom, should be higher in 12 months' time. So just a couple of final points before I wrap up here. I reckon this stuff's incredibly important. To be a successful investor, you have to try and make the most of these things. Make the most of the power of compound interest. History tells us that if you want to grow your wealth, you won't do it in bank deposits, but you will do it in assets that are connected to the real economy, that will grow with the economy, like shares. And that next chart illustrates that. Despite that 30-odd% fall in Australian shares recently, the broad trend in the Aussie share market remains up when you allow for dividends, and it provides much stronger returns over the last 120 years and even over 10-year periods, 20-year periods, 40-year periods than do other asset classes. So if we go back to the previous chart, don't get thrown off by the cycle. Try and invest for the long term. Always make sure you diversify. Don't have all your investments in one asset, like one bank. Try and turn down the noise. Try and buy low and sell high. A lot of people do the opposite. Beware the crowded extremes. There's a little chart here, but we jump through these charts. I won't go through all those charts there. This one here I like. This is the typical cycle we go through. The good times we start to feel euphoria, but often that's the point of maximum risk. And in the bad times, we start to feel depression, capitulation, depression. And of course, no one wants to buy shares, but that's often the good times. That's the time you should be buying shares. So try and not to get carried away by the crowd. And the crowd is often wrong at the extremes. Just one final chart here I'll just jump through, which shows a lot of people try and time the market. This is an old financial planning chart being used for many years. If you can time the market really well, you'll do okay. The average return on Australian shares over the last 25 years has been 8.5%. If you'd missed the worst 40 days, shown in yellow, your return over the last 25 years would have jumped up to 17%. But a lot of people don't do that. They only get out after the bad days have happened, and then they miss out on the best days. If you missed out on the best 40 days, your return would have dropped to 1.9%. So I think unless you've got some system to help you get in and out of the market, to time the market, to pick shares, you're probably better off taking a longer term approach because timing is very hard. So if we move on to the next slide, which I think should be pretty near the end, this environment we're going through is very, very noisy. A lot of debate about what it all means. Will we see a recovery? Are we all ruined? History tells us we do recover. But I think it's quite important through this period to keep your head, try and turn down the noise. One of the shows I watched last year was The Bachelor. I'm kind of waiting for the new episode. I don't know when it'll come out or if it will come out, whether they've been able to film it or not. I'm not socially adept at knowing these things, but you really need to find something to distract yourself from this noise, because the noise can be very distracting and it often triggers emotional decisions. You know, that period going into March, selling at the wrong time, or buying at times when everything is feeling euphoric and getting it wrong. So I think if we move on to the next slide, which is back to the summary, that's the way I see things. We've got about 15 minutes left for questions. Yes, we're going to see more volatility. Yes, there's more uncertainty, but it's interesting the way the Prime Minister has moved from talking about a six month hibernation or shutdown, turned out to be a lot shorter. They introduced JobKeeper. Now the focus is shifting to JobMaker. And that tells us that the focus is shifting from protecting the economy through this downturn to making the most of the recovery. And I am heartened the way the government is talking about a reform agenda to make it easier for business to hire people, to start up, to get on with the job of creating business, which I think again should help Australia through this recovery period. So I might leave it there, and hopefully there's plenty of questions.
All right, thanks so much, Shane, for those insights. That was really fantastic and always entertaining to hear you talk. We do have a couple of questions in here, so I'm just going to run them top to bottom in no particular order, if that's okay, Shane. But we've got one here from Max, and Max has said, is there a particular material adverse effect on people, on particular funds, particularly super, where people have pulled out early using the early access of super?
It can have an impact, but most super funds have plenty of liquidity, and so they're not forced to sell assets at a bad time. I mean, that would be the worst thing that happens if an asset has fallen in value and then you're forced to sell out of that asset without waiting for the recovery. But most super funds have plenty of liquidity and it hasn't really been a problem. I know there has been talk about a minority of funds, and I don't really want to get into talking about competitive funds, that it may have been a problem, but my understanding is that most funds haven't had that problem because they have plenty of liquid assets, and if there are redemptions, they can fund those redemptions.
Okay, thanks. Next question is from John. And John asks, which sectors do you think will rebound best and perform well in the medium term? For example, healthcare, pharmaceuticals, or any particular companies?
I think healthcare will definitely perform well in the medium term for a whole bunch of reasons. Obviously, there's health issues associated with this virus, but also because we've got an ageing population. So I think healthcare will be an ongoing growth sector, as will tech stocks. Occasionally tech stocks get ahead of themselves a little bit, but they've been a clear beneficiary of this crisis. And of course, they've been in massive demand, whether it's online sales via Amazon or whoever it is, Australian companies that do the same, or whether it's the sort of technology that we're using at the moment. So I think health and technology will be key beneficiaries of this. In terms of the other sectors, I would say, you know, if you think about it, energy stocks got really hard hit. In fact, when I last looked, I think they were one of the hardest in the ASX. I think that probably got a bit over the top. We did have that occasion there where the oil price, the West Texas oil price for spot delivery went negative. In other words, you had to pay someone to take the oil off you. That market is now rebalancing and the oil price has rebounded from minus something or other to, I saw last, about $33 a barrel, $35 for Brent, because we've seen a cut in production globally and we're starting to see demand pick up again. You know, when you get out there and you see more cars driving around, that means more demand for fuel. The price is going to stay below its pre-coronavirus level for quite a while, so I'll still be happily filling up my Holden at lower cost. But I reckon a lot of the oil companies, energy stocks, were oversold. I'd probably also be looking at industrials. I think they'll see a reasonably good rebound here. I'd be a little bit cautious about consumer discretionary stocks. You've got to really get out there and kick the tires. Some that have good offerings that are well attuned to benefiting from online activity will do okay, but a lot of others, I think it just spells trouble for. And even before coronavirus came along, we were seeing Australian retailers close up their shops, and we've seen more do so recently. So I think retailing generally will probably, not not the Woolworths and the Coles, but generally retailing will probably continue to struggle in Australia as we go more and more online. But those who can do it well, will benefit from this, and likewise shopping centre owners who can reposition their shopping centres as entertainment destinations will do pretty well out of this. So I think I've covered the main. Airlines are another one I'd be a little bit cautious of. It's interesting to note that after 9/11, it took more than a decade for US consumer house. I haven't got the data for Australia, but for household spending in America to get back to its pre-9/11 level on air travel. So I think tourism will come back, but it's going to be a slow grind. And I think a lot of business travel won't fully come back because businesses will be looking to cut costs and doing more activity via online activity rather than flying around.
Okay, great. Thanks, Shane. I'm going to join a couple of questions together here. So the Prime Minister today revealed in the press launch the new Jobmaker package. And we've got you talked a little bit about Jobseeker and JobKeeper. So first of all, how important are they in our recovery? And then secondly, who ultimately pays for them?
Well, we do. We pay for Jobseeker, or the increase in Jobseeker, and we also pay for the increase in JobKeeper. To be honest with you, I don't mind that because I was still fortunate to be getting paid a salary. And I thought I had to help fellow Australians, and that's one way of doing it via the government, such that when things do return to normal, the cafes, the restaurants, the services and what have you that I get the benefit of is still there. If they all had to shut up their shop because they couldn't make it through this 2-month period, then that would have been worse for me. So I'm quite happy to pay for that. And I don't think it's an onerous cost. One of the charts there, I showed the size of the budget deficit relative to what it was in World War II and World War I. And it's high, but it's nowhere near as bad as it was back then. So I think we can pay for it. And also bear in mind that Australian government borrows from Australians. We're not like a Greece or someone that's borrowing from other countries, and we control our own currency. So they're borrowing in Australian dollars and they pay back in Australian dollars at very, very low interest rates. The 10-year bond yield in Australia is about 0.9%. So you can borrow for 10 years at 0.9%. And what the Australian dollar does is irrelevant because they're paying that money back in Australian dollars. So I think they did the right thing with JobKeeper and the expansion in Jobseeker. In terms of JobMaker, I think JobMaker is more about reforming the Aussie economy. I think the focus in his speech, I didn't get to see it all, but was more about skills training and education. And that is making sure that our training programs are doing the best they can in terms of getting workers into areas where they're needed in Australia. So I think that the next phase has to be more about economic reform, making it easier for companies to do business, tax reform, where they can do that. We're trying to do that one for years, but if they can fix up, here's a crazy tax. Stamp duty is just totally nuts. You pay a massive amount of money to get into the property market. That's crazy. If you can reduce that and switch over time to a land tax, I think that makes more sense. You have to do it over time because I don't want to penalise those who've just got into property. But there's a lot of taxes you can fix up, even if we can't fix up the fact that our GST rate is too low and other taxes are too high. Deregulation. A lot of businesses will tell you it's very complicated to do things in Australia, and I think we can fix that up. And obviously skills training and things like that. So I think there are things that can be done, and that's where the focus has to be going forward, and that seems to be what the Prime Minister is talking about. But those things are mainly economic reforms as opposed to a massive amount of new spending.
Okay, I think we've got time for one more question, Shane. This one's from Andrew, and he's asking about the impact of money printing in the US market and the impact it has on the economy, particularly given we're trading well below the Dow.
Yeah, that's part of it, which I forgot to mention earlier. They are printing more money than we are. I think so far the Reserve Bank of Australia has bought somewhere over $50 billion of Australian government bonds. At one stage there, the American central bank, the Fed, was buying something like $45 billion a day of US government, a week rather, of US government bonds. So they've been doing a lot more than we have. That, of course, is probably keeping the US dollar lower than it otherwise would be, but it's also had the effect, some of that money does find its way into the Dow, into the S&P 500, into the US share market. I guess the bigger issue with that stuff is, is it going to cause inflation? Because when you print money, you're increasing your money supply. And we've seen in countries like Zimbabwe or the Weimar Republic in the 1920s that when they resorted to excessive money printing, it just caused inflation and everyone was worse off. Is that a problem at the moment? Probably not, because there's a lot of spare capacity around. I think a lot of the money printing has been to fund lending programs to various businesses in the US and just to keep them going. It won't necessarily result in a massive amount of more spending. So in the very short term, I don't see it as inflationary, but I do think we have to be careful. If economic conditions have returned to normal in, say, 3 years' time, unemployment's back down again, and we've still got all this money printing going on, then it could be a problem. So central banks do need to be cautious and keeping an eye on things. Otherwise, inflation could get out of hand in the years ahead, even though it's not a problem for the next few years.
That's fantastic, Shane. I think your insights are always fantastic, and I really appreciate that you really do help turn down the noise of the short-term market changes so that we can focus on the better game, which is the long term. So with that, I'm going to end the presentation. So I'd just like to thank everybody for coming today, and I really look forward to seeing you again in the future.
Thanks, everyone.